And the third situation here is we have multiple performance obligations. So if you still remember that when we talk about the 5 steps to apply the principle, the first step is to identify the contract. The second step, identify the performance obligations. Third step is to determine the transaction price. Fourth step, allocate transaction price to each performance obligation. And in the previous 2 situations, because we only have 1 performance obligation, actually we don't need to do much in step 2 and step 4. But in the third situation, because we have multiple performance obligations, now we need to identify each of the performance obligations to separate those and to allocate transaction price to each performance obligation. And then for each performance obligation, we recognize revenue. So and then it goes back to situation 1 and 2, depending on whether that specific performance obligation it is performed at a point in time or over a period of time. We recognize revenue either at a point in time or over a period of time when each performance obligation it is satisfied. So and then regarding step 2, identify the performance obligation. The goal here is to separate the contract into parts that can be viewed on a standalone basis. And then goods and service. So when are they viewed? How are they viewed as separate performance obligations? They are viewed as separate performance obligation if they're distinct. And then goods and services are not distinct, are combined and treated as a single performance obligation. So the key word here is distinct. And then what do we mean by distinct? A good or service is distinct if it is both capable of being distinct and separately identifiable from other goods or service in the contract. So regarding the first point, capable of being distinct, it just means the customer could use the good or service on its own, or in combination with other goods or service it could obtain elsewhere. And the second point, separately identifiable from other goods or service in the contract. One example of this is, for example, American Airlines. It ordered an airplane from Boeing, and Boeing promised to deliver the airplane. So how many performance obligation is there? The airplane is made up of millions of parts, but how many performance obligation? So there's only 1 performance obligation here because the promise from Boeing, it is to deliver 1 airplane. It is not to deliver millions of parts to American Airlines. So the promise is just 1. There's only 1 performance obligation. And that promise is to deliver 1 airplane as a whole, not millions of parts. So even though airplane is made up of millions of parts, but there's only 1 performance obligation. Yeah, those millions of parts, they're not separately identifiable from other goods or services in the contract, so from each other. You cannot just put them apart and deliver them to American Airlines. So this is what it means, distinct. And then let's look at an example. Company A manufactures the white box system, which includes the physical white box module sells for 240 individually. A 1-year subscription to platform of internet-based games sells for 60 individually. As a package deal, company A sells the white box system for 250. So company A is selling those 2 as a bundle, and the price is 250. Even though if company A is selling them individually, it is selling them for 240 and 60. On January 1st, 2016, company A delivers 1,000 white box system to company B at a price of 250 per system. So what are the journal entries? Please take 10 minutes, try to write out your own journal entry, and you can pause your video for now. So let's look at the first step. Step one. What is step one? That is to identify the contract here, right? So the contract here is company A sells company B white box system, and who is the seller? That is company A. Who is the buyer? That is company B. And the promise of company A is to deliver white box system to company B. And the promise of the buyer is to pay company A money. So company A has the right to receive money by the obligation to deliver white box. And company B has the right to receive white box and the promise to deliver to pay money to company A. That is the contract of between the two firms. And then step two is to identify the performance obligation. And the performance, how many performance obligations are there? There are two performance obligations. The first performance obligation is the white box module. And then the second performance obligation is a one-year subscription. So both of those are two distinct performance obligations. You can totally separate those two. And yeah, so the promise is to deliver a white box system which has two distinct good of service. So which has a white box module and a 1 year subscription. And then step three is to determine the transaction price. So the transaction price is 250 each system, and to deliver 1,000 systems. So the total transaction price is 250,000. That is step three. Step four, allocate the transaction price to each performance obligation in proportion to the standard non-selling price. So we have a white box. The first performance obligation is a white box module. And then we also have a 1 year subscription. And then so the standard non-selling price for the white box module is 240. The standard non-selling price for the 1 year subscription is 60. And then this 240 out of the total standard non-selling price, that's 80%. 60 out of the total standard non-selling price is 20%. So the transaction price, the total transaction price, 250 for each system, 80% goes to the white box module. So that's 200. That is the white box module that is allocated to the white box module, and 20%, that is 50, is allocated to the 1 year subscription. So that is step four. And step five, we recognize revenue when each performance obligation is satisfied. The first obligation to deliver the white box module, when is that performance obligation satisfied? So it is satisfied on January 1st, right? Because that is the date. So if you look at here, that is the date when those white box modules are delivered. That's when this performance obligation is satisfied. So the general entry we make here is we can recognize sales revenue for the 1,000 white box modules, and the price allocated to each one is 200. And then on this date, the company is also has an account receivable of 250. That is for the total system, the whole system. However, out of that 250,000, 50,000 cannot be recognized yet. So this is it. This is the amount that is allocated to the 1 year subscription, because on January 1st, 2016, the firm hasn't performed any of that service yet. Even though the firm delivered those physical modules, but the firm hasn't performed the subscription service yet. So the subscription part cannot be recognized. It should be recorded as a deferred revenue. However, for the physical modules, they're delivered already, so they can be recognized. They can be recognized as sales revenue. And then in each of the 12 months following the sale, those deferred revenue can gradually be turned into the firm service revenue. So this is 50,000 divided by 12 over, it can be recognized over the 12 months. And at the end of the 12 months, all of the deferred revenue should go into the firm sales revenue.